K92 Mining, ticker symbol KNT on the TSX. The print for their Q2 2026 earnings report just dropped, and they missed consensus earnings per share.
Right, coming in at 34 cents.
Yeah, 34 cents, which is a 13% miss versus the 0.3911 estimate. But on the top line, they absolutely crushed revenue, posting a record $205.2 million.
Wow.
I know, that is up 113% year over year, beating the $202.45 million estimate. And management also maintained their full-year 2026 guidance of 190,000 to 225,000 gold equivalent ounces.
Which is huge. And if you look at the stock reaction, day one was essentially flat, right?
Yeah.
Up at just 0.6% to $28.66.
Yeah, before dipping slightly to $28.49. But as the market spent a few days digesting the underlying cash flow, the stock just climbed over the following week. It yielded a net 11.7% gain to end at $29.26.
Well, the initial hesitation makes total sense on a headline EPS miss.
Yeah.
But that subsequent rally, tells you institutional money to look past that single metric to really see the physical execution happening on the ground.
Exactly. And that is the mission for you, the listener, in today's deep dive. We have a massive stack of sources here: earnings call transcripts, institutional equity research, press releases.
Oh, much data.
Right. And we need to figure out why the market eventually forgave that bottom line miss and aggressively bought into K92's expansion narrative. Because to understand that delayed double-digit pop in the stock price, we have to look past the staggering top-line revenue beat. We need to see exactly what squeezed the EPS.
Yeah, the margins.
Okay, let's unpack this, starting with those margins.
So the top-line numbers are being driven by a macro environment that, honestly, every gold miner dreams of. During the quarter, K92 sold 46,682 ounces of gold.
Which is a lot.
It is. But the kicker is the average realized price. It was $4,493 per ounce.
Wait, $4,493? That's incredible.
Right. That realized price is up nearly 42% year over year. So that massive influx of high-margin revenue led directly to a record cash position of $349.4 million.
Man.
Yeah, generating $105.1 million in operating cash flow in literally just 3 months.
But then, you flip to the cost side of the ledger and you see where the EPS got cannibalized. Their cash costs were $850 per ounce, but their all-in sustaining costs, or AISC, hit $1,376 per ounce.
Yeah, that's a big jump.
It is. For a mine that heavily promotes itself to retail investors as a high-grade, low-cost operation, an AISC approaching $1,400 an ounce sounds like a massive red flag.
Oh, absolutely.
I look at this like a restaurant owner trying to do a massive kitchen renovation while still serving dinner. Out in the dining room, the food sales are breaking records because menu prices are sky high and the tables are full.
Right.
But out back, the contractor bills for the new stoves and the expanded footprint, they're temporarily eating all the profits.
Yeah, the restaurant analogy is a really great framework for the financials here. But the distinction between operational inefficiency and capital expenditure is it's vital here.
How so?
Well, if their base mining costs were spiraling to $1,376 because of, say, inflation, labor issues, or just poor rock quality, that would be a structural crisis.
Right, a total disaster.
Exactly. But the institutional analysts point out that the elevated AISC is almost entirely driven by heavy capital expenditures for what K92 calls their Stage 3 expansion.
Ah, got it.
They are physically building the capacity to double their output. When you drill new tunnels, buy a fleet of massive heavy equipment, and expand your processing plant, accounting rules dictate those capital outlays get baked into the all-in sustaining costs.
Makes sense.
Yeah, so even at $13,376 an ounce, K92 is still sitting in the lower half of the global industry cost curve. They are just, writing the massive checks for the renovation right now.
I see the angle. But as financial analysts, if heavy contractor bills are dragging down the current earnings per share, the next logical step is to verify if they're actually getting a return on investment on the ground at the K92 mine in Papua New Guinea.
Right, because spending money is easy.
Exactly. Executing an underground mining expansion is incredibly difficult.
Well, the physical mining metrics from the Q2 report show they are executing at a very high level. They actually set an all-time record for mill throughput in the quarter, processing 225,965 tons of material.
Wow.
And they also set a record for total material mined at 426,012 tons, I mean, moving 500,000 tons of rock from deep underground to the surface, that doesn't just happen by accident.
No, definitely, yeah.
You don't hit those numbers unless your newly installed infrastructure is functioning with severe precision.
Yeah, and the logistics of that infrastructure from the earnings call are frankly wild. Take the twin incline.
So yeah.
For years, K92 relied on an older, much smaller tunnel they acquired from a previous operator. It was essentially a single-lane dirt road where trucks had to take turns going in and out.
Which is just a massive bottleneck.
Total bottleneck. But now, this new twin incline is fully operational, and it's like they've opened a two-lane paved interstate right into the heart of the mountain.
Yeah, and they can run those 50% larger 60-ton Volvo haul trucks.
Right. I mean, I can't even imagine the sheer terror of trying to parallel park a building-sized vehicle in a dark tunnel. But these larger trucks move faster, they carry significantly more rock per trip, and they completely bypass the underground traffic jams that used to choke their production.
Because underground mining is entirely governed by bottlenecks. Your ultimate ceiling for production is dictated by logistics. If you can't move the rock out or, pump fresh air in, you simply cannot grow.
Right.
That is why the Puma Vent incline breakthrough mentioned in the sources is just as critical as those massive Volvo trucks. They're boosting their ventilation capacity to over 600 cubic meters per second.
That is a lot of air.
It's massive. Without that influx of fresh air, you literally cannot run more diesel equipment, nor can you have more miners working simultaneously in different zones. The air supply dictates the production ceiling.
I was also looking into this new paste fill plant they're bringing online, and the engineering scale is fascinating. From my understanding, when you extract high-grade ore, you leave a giant empty cavern behind called a stope.
Yeah, a stope.
And if you leave too many of those empty stopes, the mountain becomes structurally unstable.
Obviously a bad thing.
Yeah, very bad. So instead of just leaving them empty, this paste fill plant takes the leftover processed rock, the tailings, mixes it with a cement binder, and pumps it right back underground to fill those voids.
Right.
It stabilizes the mine so they can safely blast adjacent areas. Plus, the sources note K92 will be redirecting 60% of their tailings back underground, which drastically reduces their surface environmental footprint.
Which is huge for permitting.
Exactly. That saves them from building massive, politically sensitive surface tailings dams.
So it solves a massive structural problem and an environmental problem simultaneously. And it's paying off in the processing plant, too.
How so?
Well, despite pushing all this record volume of rock through their newly expanded mill, their metallurgical gold recovery rate was an incredibly high 93.8%.
Oh, wow, 93.8%.
Yeah. Yeah. For context, retaining nearly 94% of the gold from crushed rock is exceptional. They have actually exceeded the recovery parameters set in their own definitive feasibility study for 9 straight quarters.
Okay, well, here's where it gets really interesting. Looking at this massive capital spend on the 60-ton trucks, the 600 cubic meter ventilation, the paste plants, it begs the question, are they just spending this money to keep the current Stage 3 mine afloat at 300,000 ounces? Or are they playing a much longer game here?
What's fascinating here is the forward-looking nature of this capital deployment. Management stated plainly on the earnings call that 98% of the Stage 3 capital is either already spent or legally committed.
Wait, really? 98%?
Yep. The financial drag of the kitchen renovation is effectively in the rearview mirror. But the crucial insight for the retail investor is that these specific upgrades are intentionally overbuilt.
Overbuilt how?
The ventilation and the twin incline aren't just tailored for the Stage 3 target. They are already laying the heavy logistical groundwork for Stage 4, which is a massive leap targeting over 400,000 ounces of gold equivalent per year by late 2027.
Okay, so they have the cash and they have the infrastructure largely in place. The next major question is timeline.
Right.
When does this heavy capex translate into accelerated, unencumbered cash flow for the retail investor? I mean, when do the contractor trucks leave the restaurant parking lot so we can just collect the profits?
Well, the timeline is actually accelerating. CEO John Lumens highlighted that in July alone, their underground mine development hit a record 1,220 meters.
Over a kilometer of tunneling in a month.
Exactly. To put that in perspective, they are physically digging tunnels at a rate that effectively exceeds the development requirements for the massive Stage 4 expansion. And they're doing it well ahead of the early 2027 schedule.
That's aggressive.
It is. Yeah. Because of this accelerated underground development, management expects the second half of 2026 to be an incredibly strong production period, heavily weighted toward the fourth quarter.
Yeah, the research notes the fourth quarter jump is tied to a transition into a higher grade stopping sequence. So rather than just mining average rock, This accelerated tunnel development allows them to access richer veins of ore that were previously out of reach.
Right.
They are moving the operation into the denser gold, and they finally have the interstate highway and the ventilation to extract it at scale.
Precisely the mechanic at play.
Mm-hmm.
And while all this production scale-up is happening, they aren't ignoring their future pipeline.
The exploration.
Exactly. The exploration upside is massive. They currently have 16 drill rigs turning.
16.
Yeah, to have 16 rigs operating on a single property is a staggering level of exploration intensity. They are aggressively expanding a zone called Arequipa, specifically the AR1 high-grade zone.
I saw that in the notes.
Yeah, they are planning to release a maiden resource estimate for Arequipa in the second half of 2026, which will finally put a hard number on how much gold is actually sitting in that new system.
You know, what stood out to me in the transcripts wasn't just the sheer volume of 16 drill rigs, but the quiet confidence in how they're paying for it. K92 is funding this entire massive expansion internally.
Yeah, entirely from their own cash flow.
Right. In the mid-tier mining sector, that is the unicorn scenario. Usually, a retail investor backing a growth-focused mining company has to endure constant share dilution.
Oh, absolutely.
The company wants to build a new mill, so they issue millions of new shares to raise capital, effectively shrinking your slice of the pie. But K92 didn't do that. They generated $105 million in operating cash flow in a single quarter, and they are just deploying it.
If we connect this to the bigger picture, that lack of dilution is exactly why the institutional money bought the dip after the EPS miss.
Makes total sense.
Right. That massive cash generation gives K92 immense operational agility. They can afford to aggressively drill Arequipa, buy an entire fleet of 60-ton Volvo trucks, and commission a paste plant, all without going hand-in-hand to the debt markets, or, punishing their shareholders with secondary offerings. The value of each share remains intact, while the underlying asset literally doubles in size.
Management's timeline sounds highly optimistic, and the lack of dilution is fantastic. But as financial analysts, we have to stress test the thesis.
Always.
What are the active risks that could derail this growth trajectory? Because the mining sector is littered with companies that built massive surface mills but couldn't figure out the underground logistics to feed them.
Very true.
First, there is execution risk. We mentioned the PACE system commissioning. Large infrastructure projects have to hit their marks. If there is a bottleneck in the ventilation system, or if the surface haul road widening is delayed and those new trucks can't run efficiently, does that completely ruin the production ramp-up planned for the fourth quarter?
Execution risk is paramount right now. The projections for a massive Q4 assume the paste plant works flawlessly on day one and the stopping sequence transitions without a hitch.
Right.
Any geotechnical issue underground pushes that high-grade ore into 2027. Then you have to factor in commodity price risk. The entire narrative of record cash flow relies heavily on the gold price sitting near that $4,500 an ounce realized mark. If macro forces drag gold down, the cash flow funds the expansion much slower.
Though, to their credit, the sources note K92 holds a very cost-effective put option program to mitigate that exact commodity risk.
Yeah, the insurance policy.
Exactly. They have downside protection covering 10,000 ounces a month at a strike price of $3,500 an ounce. And importantly, it is a put option, not a forward-selling hedge.
That's a huge distinction.
It really is. A forward hedge locks in a sale price, meaning if gold goes to $5,000, you are still forced to sell at your lower hedged price, completely capping your upside. But a put option is basically an insurance policy. If gold goes to $5,000, they get the full $5,000. But if the market crashes to $3,000, they have a guaranteed floor to sell those 10,000 ounces at $3,500.
Which protects the budget.
Yeah, it's a smart piece of financial engineering that secures their critical expansion budget against a sudden gold price collapse without sacrificing the upside.
It is a sophisticated safety net, but even with that floor, they are still highly levered to the overall macroeconomic environment for precious metals. However, the most significant risk, the one that requires the deepest analysis, is their single asset exposure.
Which brings us to the elephant in the room. K92's entire fortune, their multi-billion-dollar market cap, rests on a single operation, the K92 mine in Papua New Guinea.
Yep.
So what does this actually mean for the retail investor? Are we taking on an unacceptable level of geopolitical or single point of failure risk by backing a company that has all its eggs in one developing nation basket? I mean, if a major flood hits or local tribal land disputes erupt, they don't have a backup mine in Nevada or Australia generating cash to offset the loss.
This raises an important question, and is the primary reason single asset miners often trade at a valuation discount compared to diversified majors.
Makes sense.
Operating in Papua New Guinea carries complex geopolitical realities, including navigating historical tribal land rights and shifting national policies. However, analyzing the institutional research, it is clear K92 understands this existential risk and is aggressively mitigating it through deep local integration.
How so?
Well, they aren't just operating an enclave. They are making themselves indispensable to the local economy.
Oh, I saw that. I was looking at their workforce data, and it seems they've hired almost entirely locally. Something like 91% of their staff is from Papua New Guinea.
Right.
That creates a massive local economic engine. But is that really enough to insulate them from a potential government policy shift or a labor strike?
It is a critical first step, but the financial integration is what really secures their social license. In 2025 alone, they paid $139 million in taxes and royalties to the government.
Wow, $139 million.
Yeah, and for 2026, they had already paid $121 million in corporate tax by the end of June.
That's massive.
They are a vital, undeniable contributor to the national treasury of a developing nation. When you are contributing that heavily to the sovereign budget, the government is highly incentivized to ensure your operations run smoothly.
The sources also highlight their use of the infrastructure tax credit scheme, where K92 is directly upgrading the Conquo-Billamoya road network.
Exactly.
Instead of just sending tax dollars to the capital and hoping it trickles back down, they are directly funding and building infrastructure for the local communities surrounding the mine.
Right.
By tying the success of the K92 mine so inextricably to the immediate prosperity of the local community and the national government, they create a buffer against that single asset risk.
Yeah.
It doesn't eliminate the danger of a natural disaster, but it heavily insulates them against political turbulence.
It is the gold standard for how to operate effectively in an emerging market. You secure your asset by ensuring the host nation shares heavily in the economic windfall.
So, to synthesize all of this for you, the listener, here's the bottom line on K92 Mining's Q2 report. They missed bottom line earnings because they are writing the massive immediate checks required to double their production capacity in Stage 3.
Right.
But they absolutely crushed revenue and operations. The market initially hesitated on the headline EPS, then aggressively bought the dip because they realized that the new infrastructure, the ventilation, the twin incline, the paste plant, it's finally translating into record physical rock moving.
Yep.
And crucially, they are funding this entire growth story from their own internal cash flow, protecting retail shareholders from the dilution that plagues the rest of the mining sector.
It is a remarkably rare combination. A company actually executing on its physical engineering promises underground, avoiding debt, and simultaneously enjoying the massive macroeconomic tailwind of record-high realized gold prices.
If you want to keep tracking stories like this, make sure you follow the show for our daily earnings coverage and financial deep dives. We do the heavy lifting through the financial statements, the institutional research, and the underlying mechanics, so you don't have to.
And before we wrap, there is one final angle to consider as we watch this company successfully scale its operations.
Right. Think about the restaurant metaphor we used earlier. K92 is finishing up the massive kitchen renovation. The heavy lifting is done.
Exactly.
They are fully staffed. The menu is producing record margins, and they have zero debt. They are scaling up toward 400,000 ounces with Stage 4 and uncovering massive new high-grade systems like Arakompa just down the road.
It forces you to look at the broader mining landscape. Major gold mining conglomerates are currently facing a crisis of depleting reserves.
Yeah.
They are mining gold faster than they can find it.
It really does pose a fascinating question. Does their massive cash pile, high-grade output, and successful de-risking of a single asset make them an irresistible acquisition target for a major gold miner desperately looking to replace those depleting reserves?
Yeah.
When the renovation is finally finished and the cash flow is completely unencumbered, who is going to swoop in and try to buy the restaurant?
A provocative puzzle to mull over until next time.